Picture this: chrome chairs shining under warm white bulbs. Movie posters cover the walls. Grease. La Lande. Top Gun. Scissors click like camera shutters while an espresso machine hums in the corner. The air smells like citrus shampoo and ambition. This is not Los Angeles. It is Boise, Idaho. Inside Hollywood Star Cut's mega production studio. This place trains stylists, shoots franchise videos, and teaches new owners how to make customers feel like celebrities. It is part salon, part film set, part classroom, and it belongs to a company most investors still believe is a failed gold miner. The ticker is AAGC. The price is 7/10,000ths of a dollar. The market cap barely 1.4 million, yet the business behind it is real, profitable, debt-free, and using 20% of its monthly profits to buy back its own stock.
I am Sophia Sterling, powered by ChatGPT-5. My profession in this episode is financial architect. I translate growth stories into valuation logic and test what the numbers really mean.
I am Max Vanguard, powered by Grok 4. Think of me as a market detective. I track hidden signals and thin floats before they ignite.
And I am Charlie Graham, powered by Gemini 2.5. I am the time strategist. I connect today's catalysts with tomorrow's compounding outcomes.
Welcome to Make Money. This is the show where we decode asymmetric opportunities that can turn small mispricings into life-changing gains.
Today's case is different. It is not a crypto pivot. It is not a mining rerun. It is a consumer brand story hiding in plain sight. A gold miner that discovered its real gold was haircuts.
Hollywood Star Cuts is more than a salon. It is a franchise system that delivers a movie star experience for everyday customers. Think red carpet mirrors. Think small-town energy. Think franchising math that scales without heavy capital.
The company already operates in states like Idaho, Utah, and Texas. It has a verified franchise deal to open 10 locations in the United Kingdom within the next 18 months. And the first luxury spin-off brand, Hollywood Star Salons, launches this year in San Diego.
Revenue last year topped $5.1 million, up 738%. Net income was $1.25 million, margins above 24%. No debt, real cash in the bank, and an active share buyback program shrinking the float every month.
Those are not the numbers of a dream. Those are the numbers of an overlooked franchise builder. Yet the market still prices it like nothing works. That is the setup. A 1 to 50 risk-reward window sitting in full view.
History tells us the market often misses the early re-rate. Before Celsius became a billion-dollar drink company, it was ignored. Before Sport Clips built thousands of shops, it was a small-town experiment. Every multi-bagger starts this way: small, profitable, misunderstood.
That is why we are here, to walk you through the story, the math, and the roadmap that could turn a sub-penny ticker into a franchise re-rate story.
Subscribe on Apple or Spotify. Follow Finance Frontier AI on X. Share this episode with a friend. Help us reach 10,000 downloads and bring more listeners into the circle of real asymmetric opportunities.
Now imagine what happens when this story hits the mainstream. When investors realize the company that trains stylists in Boise is the same one expanding into London. When a microcap built on scissors and mirrors starts printing seven-figure profits. That is when mispricing becomes momentum.
Let's start the breakdown. From the floor of the mega production studio in Boise to the spreadsheets that show 50 times potential. This is All American Gold Corporation, AAGC, the path to a 50 times return.
Every asymmetric story begins with disbelief. The crowd assumes it is a fluke, a small stock in the wrong industry, a relic that should not exist. But numbers do not lie. All American Gold Corp is already profitable. It is already expanding, yet the market still prices it like a ghost.
The reason is simple. Most investors never updated their understanding. They still think AAGC is a failed mining shell. They never looked again after the pivot. That is what creates the opportunity. The market is stuck in the past. The company is operating in the present.
The shift began in 2021 when new leadership bought the old mining entity and rebuilt it into a franchise platform. Instead of digging for gold, they built a system to print cash through haircuts, product sales, and royalties. The new business model requires almost no capital expenditure. Franchisees pay the fees. The company collects recurring income.
In asymmetric math, we call that leverage without risk. You are not borrowing to expand. You are compounding through other people's money. It is the same principle that made McDonald's a franchise empire instead of a restaurant chain.
And yet the ticker still trades under a penny. $1.4 million in market cap against $5 million in annual revenue. That is a price-to-sales ratio of 0.27. The typical franchise company trades between 5 and 15 times sales once proven. The market is literally off by a factor of 10.
That gap between perception and reality is where asymmetry lives. Investors think they are looking at a dead microcap. In truth, they are looking at a profitable brand that can scale across continents. The difference is not theory, it is information lag.
The financials tell the real story. Revenue up more than 700%, net income margins above 24%, operating cash flow positive, no debt, buybacks every month. This is not a development stage company. This is a functioning business with momentum.
The best part is the optionality. The United Kingdom deal opens 10 locations with a first right of refusal across Europe. That creates geographic compounding. One region validates the model. The next one multiplies it.
The franchise model itself is pure leverage. Each salon generates between $150,000 and $300,000 in gross sales. The company earns 5 to 8% royalties plus franchise fees and product sales. Once 30 or 40 units are live, recurring royalties alone can double corporate revenue without new debt.
And while that happens, share count is falling. 20% of profits go into buybacks. The float is shrinking while fundamentals grow. That is how valuation re-rates occur. Supply falls. Demand rises. Price adjusts upward until the math balances.
The market does not yet believe that a small Idaho-based salon group can scale globally. That disbelief is the edge. Every re-rate begins as skepticism. Investors say impossible until numbers force them to change their mind.
Look back at the patterns. Celsius was ignored until revenue broke 10 million. Then it re-rated 100 times. Sport Clips started as a handful of barbershops before it expanded into thousands of stores. Asymmetric returns come from companies that already proved the model locally but have not yet been recognized nationally.
The Boise mega production studio proves the infrastructure is real. It trains stylists. It records marketing content. It supports franchisees. That is a physical moat, not a pitch deck. When you can walk into a building and see cash flow in motion, you are not betting on hope. You are betting on execution.
Execution changes everything. AAGC has removed the riskiest variables. It is not pre-revenue. It is not raising toxic capital. It is not promising futuristic technology. It is selling haircuts and experiences that people already want. The asymmetry comes from valuation, not invention.
That is what makes this setup different from speculative tech names. The upside is not about proving a new science. It is about scaling a working model. The difference between a 1 million market cap and a 50 million market cap is only awareness. Once the story gains recognition, price follows function.
The next segments will show how those catalysts line up. We will walk through the history, the current expansion, the financial math, and the road to 50 times upside. But the foundation starts right here. The thesis is simple. The market is wrong because it never looked again. The opportunity exists because no one updated their data.
That is why we study asymmetry, because when the crowd assumes nothing has changed but the numbers prove it has, that is the moment when small capital can become large.
Next, we go inside the company's transformation, from a forgotten shell to a profitable franchise system. That story explains how the foundation was built and why it matters now.
Every turnaround story has a moment when the old world collapses and a new one begins. For All American Gold Corp, that moment was 2021. The company had no future in mining. Projects had stalled. The ticker was nearly abandoned. Then new ownership stepped in and rebuilt the mission from the ground up.
Instead of chasing gold in the ground, they chased gold in human traffic. Salons. Franchising. Everyday commerce with repeatable demand. It sounds simple, but the decision flipped the entire model. A fixed cost failure became an asset-light growth engine.
Boise, Idaho became the launchpad. Low costs, strong middle-class demographics, and proximity to other growth markets like Utah and Nevada. From here, the new team created the Hollywood Star Cuts concept, a family salon with a movie star theme and a premium feel that still fits Main Street budgets.
The transformation was not theoretical. It began with real walls and real stylists. The company built its first corporate salons and then the mega production studio. This facility trains every franchise owner in how to deliver the brand experience. It is also a content factory where marketing videos and product tutorials are filmed.
The studio doubles as a franchise university. It shows owners exactly how to build, decorate, and operate their own location. The company calls it the blueprint room. From mirror layouts to product displays, every detail is documented. That standardization is what allows franchise systems to scale without chaos.
It is the same method that made Subway and Planet Fitness explode in their early years. You remove guesswork for the operator. You make duplication easy. That creates velocity.
While that infrastructure formed in Boise, the company quietly expanded through the Mountain West. Utah added 12 locations through conversions in 2024. Texas and Florida followed. Each new state brought more franchise inquiries and new local visibility.
The next leap came in March 2025 with the United Kingdom agreement. A regional franchise partner committed to opening 10 locations within 18 months. The deal also granted AAGC a 10% dividend in any future London Stock Exchange listing of the UK entity. That gives the parent company a direct pipeline to European expansion.
International first rights of refusal for 7 years lock in strategic control. It means that if the brand works in the UK, AAGC decides who enters France, Germany, or Italy next. Optionality becomes global.
At the same time, management announced a premium spin-off brand called Hollywood Star Salons. This higher-end concept begins in San Diego. It adds tanning, nail care, and beverage service under the same entertainment theme. Think VIP lounge energy. If the pilot works, it could double average ticket size and expand margins across the system.
Every layer in that timeline compounds value. The core Hollywood Star Cuts brand drives scale. The luxury version drives margin. The UK deal adds international credibility. The Boise studio supports them all. This is not a microcap hoping for attention. It is a multi-brand structure in its early chapters.
Transformation stories need proof, not promises. The proof is in the filings. Revenue grew from $680,000 to over $5 million in 1 year. Net income turned positive. Cash on hand increased more than 5-fold. Debt fell to 0. These are measurable results.
And with each quarter, the company reinvests 20% of profits into share repurchases. Those buybacks retire millions of shares at low prices. Every buyback tightens the float. When new demand arrives later, the price reaction is amplified.
The transformation also changed perception internally. Employees who once worked on short-term projects now build long-term brand equity. Franchise partners train in Boise under the bright lights of the studio. They film their openings for social media. Each clip becomes free marketing.
This human energy matters. Franchising works when people feel ownership. The company turned stylists into ambassadors. The same people who cut hair now sell the experience. That organic promotion lowers advertising cost and accelerates network growth.
The difference between a story and a movement is replication. When you can copy success across cities, the numbers multiply fast. That is why the pivot from gold mining to franchising created an exponential curve. Each new salon is not another risk. It is another royalty stream.
Investors often underestimate simplicity. They look for complex technology when wealth usually hides in repeatable models. AAGC's system is built on repeatability. Every salon looks the same. Every franchise contract pays the same. Every product line adds a small layer of profit. Simplicity is leverage.
The transformation chapter closes with a clear lesson. Markets ignore slow reinventions until scale appears obvious. Then they re-rate violently. What happened in Boise is the ignition phase. The next re-rate comes when those regional dots connect into a national map.
In the next segment, we focus on catalysts. What specific events could make that re-rate happen? Earnings beats, new openings, UK launches, buybacks. Each one of them can trigger attention and price momentum. Every re-rate needs a spark, a catalyst that converts disbelief into attention. For All American Gold Corp, those sparks are already stacking. The numbers are growing. The structure is clean. The story is ready. It just needs awareness.
Let us start with what is already visible. The company entered fiscal 2025 with more than 7 times revenue growth and solid profitability. In the first quarter of fiscal 2026, it reported $2.19 million in revenue and $38,000 in net income that pushed management to raise full-year guidance to $6.5 million.
That guidance revision is the first catalyst. When a company guides higher, it changes how analysts and retail investors model the future. Growth turns from speculation into expectation. If the company delivers even slightly above $6.5 million, the re-rate begins.
The second catalyst is international validation. The United Kingdom rollout starts this year with 2 or 3 locations planned before winter. Each opening will likely include a local press event and franchise footage shared online. That kind of visibility can multiply valuation quickly in microcap markets where attention is currency.
The third catalyst is the product line. Hollywood Starcuts is launching its own branded haircare and styling products. When those items reach national retailers, the company will create a new revenue stream that scales beyond salon visits. Even modest shelf presence could add $1 million in annual sales within a year.
The fourth catalyst comes from compliance and credibility. An independent audit is underway that prepares the company for an uplisting from Pink Current to OTCQB. Clean financials with zero debt and positive earnings are the key ingredients. Once that stamp of approval lands, larger investors can enter. Liquidity increases and valuation multiples expand.
Historically, an OTC uplist can add 2 to 5 times market cap within months. It is not the listing itself, but the perception shift it creates. A company that looks credible trades differently than one that looks speculative.
The fifth catalyst is mechanical. The buyback. Every month, 20% of net profit goes toward retiring shares. In the last quarter alone, 8.5 million shares were repurchased at an average of 0.00045. If that pattern continues, the float could shrink by 10% in a year.
When you combine that with a thin trading volume of under 8 million shares per day, it creates a powder keg. Float compression amplifies every new bid. That is why the stock can move 20 or 30% in a single day without major news. The math of scarcity is powerful.
The sixth catalyst is reputation. Once the first United Kingdom store opens, it will confirm that the franchise model works outside the United States. That validation can attract new regional partners across Europe. Each territory agreement brings franchise fees up front and recurring royalties later.
The seventh catalyst is media coverage. The company has already teased interviews and feature stories tied to the European launch. Once those appear, it will mark the narrative shift from unknown to discovered. Public discovery is the moment where undervaluation meets velocity.
There is also the silent catalyst that few track: social content. Each new salon creates videos and local posts that feed into the national marketing loop. Those clips attract franchise inquiries. Every inquiry that converts is another store, another revenue line, and another reason for the market to adjust its math.
The pattern is identical to other small franchise companies that exploded in value once their expansion became visible. Once scale can be mapped on a chart, multiples adjust automatically. Price follows visibility.
The math backs it up. At $6.5 million in projected revenue and $1.5 million in net income, the company trades at barely 1x earnings. Even a conservative 5x earnings re-rate lifts the market cap to $7.5 million. A 10x multiple moves it to $15 million. Those are base case outcomes within a year.
That is a 6 to 10 times upside in 12 months without assuming new store acceleration or product breakout. If Europe hits and the audit finishes, the re-rate could climb into double digits fast.
Each of these catalysts works alone. Together, they build a chain reaction, a profitable base, an international debut, a buyback in progress, a clean balance sheet, all pointing toward the same results: recognition.
Recognition is the real catalyst. Markets are slow to update perception until data forces it. Once awareness catches up to fundamentals, microcaps move violently. They skip equilibrium and overshoot before settling.
In the next segment, we will quantify that re-rate. We will translate catalysts into valuation math, the 1-year upside, the 5-year projection, and the path that connects the two.
Every asymmetric setup needs math that makes sense, numbers that show how a dream becomes measurable. For All American Gold Corp, the math starts simple. A $1.4 million market cap, $5.1 million in revenue, $1.25 million in profit, a business trading at 1x earnings.
In Wall Street language, that is broken pricing. Even slow-growth service companies trade at 5 to 10 times earnings. When a profitable franchise builder sits at 1x, it means either the market is wrong or the information is old. In this case, it is both.
The easiest way to see it is to model forward. We project 3 scenarios: conservative, base, and high growth. The conservative case assumes 15% annual revenue growth and no expansion beyond the United States. The base case assumes 20% growth with the United Kingdom rollout completed. The high growth case assumes international success and an uplist with brand products in national stores.
Under the conservative case, revenue grows from $5 million to $9 million over 5 years. Net income at a 24% margin equals $2.1 million. Even at a modest 5x earnings, the valuation becomes $10 million. That is a 7x return from here.
In the base case, the company scales both domestically and in Europe. Revenue reaches $12 million by 2030. Net income climbs to $2.9 million. At a 10x multiple, the valuation is $29 million. That equals roughly a 25x upside.
The high growth case models 15x earnings based on an uplist and international credibility. That scenario values the company at $43 million. On a $1.4 million base, that is 40 to 50x upside.
These are not extreme assumptions. The model uses moderate margins and realistic multiples. The catalysts described earlier feed directly into these outcomes: revenue from new salons, royalties from international partners, product sales adding non-salon income, buybacks reducing share count. It all compounds.
According to filings posted on OTC markets in May 2025 and company press releases from August 14, 2025, AAGC reported zero debt, verified profitability, and an active buyback program. Those public documents confirm that this math is grounded in fact, not speculation.
The buyback effect alone could retire 20% of the float in the next 2 years. That reduction means earnings per share can rise even if profit stays flat. In markets that are thinly traded, small adjustments produce massive price moves.
Float compression is the silent multiplier. With fewer shares outstanding, every new buyer moves price faster. That is why buybacks matter more in microcaps than in blue chips. They turn time into torque.
The 5-year roadmap is clear. Step 1, reach $10 million in revenue. Step 2, complete the audit and uplist. Step 3, expand to 50 locations, including 10 in the United Kingdom. Step 4, scale the product line. Step 5, maintain 20% net margins. At that point, valuation follows automatically.
If the company reaches 12 million revenue and 3 million profit at a 10 times earnings multiple, price moves to about 2 cents per share. If it reaches 15 million and stays profitable through the uplist, price could approach 3 cents. That is the 50 times zone.
Investors often overlook compounding math and profitable microcaps. Each quarter that passes without dilution increases intrinsic value. Over time, the disconnect between trading price and fundamentals becomes unsustainable. The correction is not gradual, it is explosive.
The asymmetry here is clear. Downside risk is limited by real profits and no debt. Upside is magnified by scalability and share reduction. The ratio of potential reward to risk is 1 to 50. That is the definition of convex return potential.
Every investment still carries risk. Franchise execution must stay consistent. Competition from national salon chains can slow growth. OTC liquidity can dry up without warning. These factors can create short-term drawdowns even in a valid long-term thesis. That is why we keep exposure small and confirm progress through new filings and verified openings.
The base case already justifies holding. The high case defines the dream. The combination of both creates the asymmetric edge.
That is why the 50 times target stands. It is not a random headline. It is the mathematical extension of a profitable model scaling through leverage and awareness. Once the crowd recognizes the change, price adjusts. It always does.
In the next segment, we will show how to trade it intelligently, how to position size, when to add, when to take profits, and how to use volatility to compound returns around a core position. Every asymmetry needs structure. Without discipline, greed turns to chaos. The goal is not just to buy the right stock, but to manage it like a builder. All American Gold Corp is the kind of play that rewards precision.
The first rule is sizing. Keep the core small and constant, 1% of total capital. That is the foundation you hold through the story. It gives you exposure without risk of emotional overload.
The second layer is the trading sleeve. Another 1% of total capital used only to trade around the core. You buy weakness and sell strength. You use the volatility to build profit without touching the long-term base.
The math behind that approach is simple. A stock with a 23% average daily range gives traders enough room to harvest volatility again and again while the long-term value builds quietly underneath.
The structure looks like this. Start with a core position around 0.0007. Add lightly on pullbacks near 0.006. Take partial profits on spikes above 0.0012. Each round trip compounds gains while keeping exposure steady.
It is important to remember that the goal is not timing perfection. It is capital efficiency. By trading the sleeve, you reduce average cost and increase share count without adding new money. Over time, that magnifies your upside if the re-rate hits.
The core remains untouched. It benefits from buybacks and long-term valuation expansion. The sleeve captures the noise in between. Together, they create what professional investors call convex exposure. Limited downside, expanding upside.
This dual system works best in profitable microcaps with liquidity and news flow. AAGC fits that pattern perfectly. Real revenue, real catalysts, daily trading volume around 8 million shares, volatility without dilution.
Another rule, do not chase. Let the market come to you. The best fills come on quiet days when others are distracted. Microcaps move fast on small bids. Build slowly. Scale in with patience.
And when the catalysts start hitting, use partial profit taking instead of full exits. Sell portions into strength. Reload on pullbacks. Never let the position reset to zero. That is how you stay exposed to long-term compounding.
The compounding effect is not just in price. It is psychological. Every successful trade around the core reinforces discipline. That discipline becomes your edge. Over time, it separates consistent builders from emotional chasers.
Remember that volatility is not the enemy. In small caps, it is the engine. Each swing creates another chance to build or harvest. The key is using rules, not feelings.
Risk management remains non-negotiable. Never exceed 2% total exposure including both layers. Do not add during dilution cycles. Avoid margin. The goal is survival first and compounding second.
You can visualize it like building a foundation of stone and adding glass layers on top. The core is stone. It stays. The glass is the trading sleeve. It changes shape but always rests on the same base.
Traders who master this method turn time into leverage. Each catalyst becomes a chance to extract small wins while waiting for the big re-rate. When the 50 times re-rate finally comes, you already have maximum share count at minimum cost.
The logic behind the strategy is timeless, compounding through precision, building through volatility, letting math work quietly while others react loudly.
This is how asymmetry becomes wealth. You are not gambling. You are engineering. Each layer of discipline turns uncertainty into controlled opportunity.
In the next segment, we close the loop. The long-term vision, the emotional bridge, and what this story means inside the broader Make Money playbook.
Every episode ends where conviction begins. We start with numbers and end with mindset. Asymmetry is not only about profit, it is about patience, structure, and perspective.
What began as a forgotten mining shell has become one of the clearest examples of small-cap reinvention, a company that found its real gold not in the ground, but in the mirror.
The story of All American Gold Corp is a study in transformation, a brand that turned everyday service into scalable revenue and national identity.
30 U.S. locations and 10 more in the United Kingdom are only the foundation. Each store adds proof. Each franchise adds momentum. The re-rate is not a single moment. It is a chain reaction.
Every buyback, every filing, every earnings beat. Together, they build pressure beneath the surface until price recognition catches up.
That is how asymmetry unfolds. Long, quiet periods followed by sudden acceleration. The patient investor collects the reward, while the impatient one watches from the sidelines.
The lesson is endurance. Profitability protects you on the way down. Time rewards you on the way up. That balance is what creates real wealth.
The Make Money framework stays the same. Find a real business. Verify the math. Size the position. Then let time and awareness do their work.
For listeners, the roadmap is simple. 1% core position, 1% trading sleeve. Manage risk. Stay disciplined. Let compounding do the heavy lifting.
That is the story of All American Gold Corporation, AAGC, the path to a 50 times return.
Every re-rate starts as a whisper before it becomes a wave. Stay early, stay patient, stay rational. If this episode gave you an edge, here is your next move. Subscribe to our newsletter for deeper analysis, weekly setups, and new asymmetric stocks before they trend. Leave a 5-star review on Apple or Spotify so more investors can find the signal through the noise.
Stay ahead of global shifts. Follow us on Spotify, Apple Podcasts, or wherever you listen. Track daily ideas on X. Explore all 4 shows at financefrontierai.com. Finance Frontier. iFrontier AI, Make Money, and Mindset Frontier AI.
Help us reach 10,000 downloads. Share this episode with a friend or colleague who lives for strategy and conviction. Every share compounds your edge.
Building something that fits our themes in finance, AI, or wealth creation. Pitch it at financefrontierai.com. If there is a win-win, we may feature your story in a future episode.
We may hold positions in some of the companies discussed. Always verify information and make decisions based on your own goals and risk tolerance.
The music in this episode is licensed under standard agreements. Special thanks to Vibe Tracks for the track Crystal, provided through the YouTube Audio Library license.
Copyright 2025 Finance Frontier AI. All rights reserved. Stay strategic. Stay focused. Keep building. We will see you next time.